Hello and welcome to a brand new show of Market Makers. My guest on the show today needs no introduction. She's a long-term India bull. She's got decades and decades of wealth management business, and being bullish has paid her rich dividends. Punita Kumari Sinha, Senior Managing Director, Blackstone. She joins us from Boston now. Punita, good evening and thank you for joining us on ET Now. Punita, last time when we interacted on this forum, that was on the eve of Union Budget. That time your view was Indian markets are attractive but valuations are rich. Currently, how would you characterize the environment?
Of course, markets have gone up since the budget, as have all markets gone up. So valuations are now less compelling even compared to then. One of the things, we've done some analysis, and earnings typically recover after the equity markets. In previous recessions, historically that's been the case, and this was the case this time too, that markets actually rallied much sharply before even the budget, and only now we are beginning to see some earnings recover. We are seeing earnings estimates go up, and the markets are now they've run ahead of the earnings recovery. But even after the earnings typically start recovering, the markets still generally move up a little bit more, but not as sharply as they move prior to the recovery. So based on that, I would say that if the earnings come through good and the earnings estimates get revised up some more, then the markets potentially could trade up some more, but obviously the sharp moves that we've seen are behind us.
Punita, historically Indian markets have always moved in a PE band of 15 to 18, 18-19 perhaps on the upside, 14-15 on the downside. What's your sense in the near foreseeable future? What band do you think Indian markets can demand and command?
The typical, no markets ever trade at its fair value range. They always overshoot or on the upside or on the downside. Right now, the markets are trading slightly above their historical mean valuations in India, and also possibly for some of the other markets. India is also trading at a slight premium to the rest of the Asian region, but then it has always done that in previous earnings recovery cycles. So could India trade continue to trade at a slight premium? I think it probably could, and could it overshoot? It could overshoot, as we've seen in the past, that even if the market is at fair value today, does it have the potential to overshoot? And that depends on the news flow that comes out of the world and also from India from here on, in terms of the earnings that are getting reported and are going to continue to get reported over the next 2 quarters.
So what's your view on earnings, Punita? We are in the middle of earnings season. On aggregate basis, numbers are impressive, but individually there are some chinks in the armor.
I think I would say in some cases earnings have been above expectations, in some cases at expectations, but we haven't seen too many disappointments. If you just look at earnings estimates, consensus earnings estimates, they fell from the peak in 2008 by about 40%. When the stock markets, started correcting, and now they've rebounded about 20-25%. So can the earnings estimates get revised up further? They can if the earnings continue to come through. But bear in mind that a lot of the earnings recovery has to be led by top line growth as well. Right now we've seen a lot of it being led by margin expansion, but we need to continue to see top line growth.
So Punita, what is your view on global liquidity? Earning is one driver, the other one is liquidity. In your assessment, will this entire Goldilocks scenario, will it continue to emerge?
Of course, I think, as I said, as it is, we are kind of above fair value range for the Indian market, but then markets do overshoot if the news flow continues to be good. So it's very critical that the news flow and the earnings now come through. And even when earnings do rebound, as I mentioned, the stock markets have already anticipated a large part of that, and while they can trend up, the recovery in stock prices from here on isn't going to be as sharp as it's been. So it's very critical that I think from here on what happens globally is quite important, as is also the earnings within India.
Punita, in the credit policy, the central bank has kept key interest rates unchanged, but it appears that interest rate or hike in interest rates, that's imminent now.
I think credit growth is still not at peak levels. It's nowhere near what it should be for a growing economy such as India. So I think credit growth needs to recover more sharply. Right now the banks have a lot of liquidity, and that liquidity is not being channeled into loans. A large part of that is because there are a lot of companies are doing QIPs, and they're taking the equity first, and then they're going to possibly come to the banks for loans. That's more in the power and infra sector, and that should pick up over the next year or two. We also think that there is in the manufacturing sector right now, companies are still deleveraging, so they're not looking for new loans other than restructuring old loans. So I think credit growth needs to pick up. And whether they will be tightening or not depends on a number of factors. I think the inflation, the excess liquidity, and whether there is demand for credit growth. I don't think there is that much right now. I think that the demand needs to pick up, according to me, before they start tightening.
Right. The other obvious fear, again in the short to medium term, is high commodity prices and impact of high commodity prices on inflation.
Well, yeah, but I think right now the inflation numbers are still. I mean, there is the central bank needs to balance inflation with growth. So I don't know which way they're going to go, but I think as far as the growth is concerned, it could be better. So based on that, I think even if commodity prices keep going up and inflation goes up very sharply, then they may tilt towards tightening sooner rather than later.
All right, Punita, now that we've identified the forest, let's start talking about the trees. In the last 3 months, what's been your basic portfolio approach? Give us a sense, perhaps a flavor of what you've done in terms of allocations, sectors, adjustments.
Well, the last 3 or 4 months, we had done a rights offering of our fund. So we raised new money. So we were really focused on trying to deploy that money and investing it into the market in sectors, that we thought would be both stories for the long term as well as select mid-cap names.
So let's start talking specifics.